Howdy folks, Mark Hewitt here from Flipside Traders. It is Friday afternoon. Just wanted to go ahead and touch base and talk about the additional opportunities that we're pursuing in association with a longer duration credit spread, which we have, we call our 50% rule. A little bit different than our kind of 11-hour option trades when we're just in the market for a very short time. So wanted to kind of lay those out, compare and contrast, and talk about some of the mechanics so you guys will feel more comfortable with these as we move forward, because I think that you're ready and more mature enough now to really look at some other opportunities and then take advantage of some more trades in the market. If this post is still confusing, you have questions, feel free to give me a shout. If not, there's also some additional resources on the website. This first post here really talks about the genesis of the 50% rule, and how it's formulated, the mathematics and the theory behind it. It was developed by folks that are much smarter than I am, but I was able to take their work and bring it into from the theoretical world to the practical world, and had some great success with that, and I want to share that with you. In addition, there's some more context of trades, of how and why we do this, and why our POP, or profitability or profit, increases when we shoot for a 50% rule when we're in the market for multiple days. All right, so let's do the compare and contrast, and let's start off with 11-hour option trades in SPX. So let's go ahead and pull SPX back up over here, and let's see, here we go. So normally what we do is, you can see right here, is the day before expiration. We want to be in the market a short time, so we're taking a look at a number of different things, and we take a look at basically the overall trend, and we take a look at the momentum, and barring any kind of black swan news type of events, we then can make a very good educated guess with a high probability of profit, around 90%, and decide that we want to go ahead and sell a bear call credit spread. And we did that right here. And when we do that, we usually sell about 10 contracts. In order to achieve our risk-reward ratio, we sell them somewhere between 20 and 30 cents, in this case 25 cents, which yields us a max profit of $250 if they expire worthless. And in most cases, they do. And so that really helps us with our overall compounding interest on our P&L graph over time in our account. Now, and so that's very different from more or less a longer term trade. Okay, so let's pull that off and talk about the two paper trades that we've done so far in Amazon. So we take a look at the Amazon trade, and let's go back here and scroll back so you get a feel for the overall genesis. Is what we did is we set it up for, it's scrolling like crazy. Here we go, bring it back a little bit. So on Tuesday, the 26th, you can see that we started having downward momentum right through here, moving this way, right, downward trend. And so it was like, okay, we can put on a bear call credit spread. And we said, okay, we have momentum going our way, we have the overall price action from a trend perspective moving our way. We know we have some good protective resistance, so we said we'll put it up here for 1670, 1675, and we sold it for 50 cents. And then we said that once you sold it for 50 cents, just go ahead and put a GTC, or good to cancel order, for 25 cents. Now that's basically 50% of the overall max profit for our target. And what that does, it really helps minimize our overall risk exposure, to the market, because the longer you stay in, the more the different things can happen. Well, things started really, working our way. We had a really, good pounding right here. Is that the market dropped after hitting this resistance point, and things seem to be working our way, except that I noticed that when we made this drop, that the market makers didn't really change our P&L very much. Usually we see a drop of like 25 or 30 points like this, when it moves in our favorable direction, i.e. bearish, is that our P&L for the credit spread should jump up a couple $100. It didn't. It only jumped up like $50. So that told me that there was a little bit of a concern, a warning bell that the market makers were playing games behind us. So we had this secondary support that you can see right here at 1639. And what we did is we said, once we broke it, and we broke it right here, and we actually sent out a text message at like 7:49 that day to close this for 85 cents, which is the 35-cent loss, which is a $350 loss on the overall trade. Not good news, but that's the way you want it to go, because we didn't want it to stay in the market the full time, because you can see we stayed in the market the full time and we closed above our short strike, and that would have impeded some max loss. So that's all about trade management and how that works. Okay, so let's take a look at our next one. So we also had on the daily, we had what was known as a daily squeeze, which means that we expect the market to go up, and it kind of was in this consolidation phase right here. And usually what happens is the way the market works is that it pumps up, right? Pumps up, consolidates, and usually pumps up, because the squeeze is basically it's a continuation indicator. But when we sold this, at this point, we went ahead and we sold, let's see, right here, we sold the 1650. So let me get rid of that and let's show you where this is. So let's format that horizontal line. Let's put it down where our short strike was. It was like a 1650, 1645. So we're down here, right? We're back below this overall protective support line, and we have everything moving up in our favor. And the goal is that we only want to stay in the trade for a little, just a little while. Well, we're in the trade, and sure enough, just before the close, we went ahead and right here on this yellow candle, this yellow bar, that little spike up, that went ahead and it hit our target. And hit our target at 25 cents, so we booked $250, and basically I think it was in one day or even in less than a day. And that really saved our bacon, because you can see the longer you stay in the market, the context changed. Our momentum really went hard back to bearish. The price action went back to bearish, and we would have gotten stopped out. So the whole idea is that it limits our exposure by taking advantage, again, of the near-term trends that we see, such that we can still garner the same amount of profit that we have done in the past. So what's very important is the great thing about a good cancel order is that in a way it's set and forget if it hits your profit target. If it does not hit your profit target, and we send a message out to close the trade, you have to ensure that the trade is closed. In the previous case, we sent it out for 85 cents, and if you get in there and the market's kind of bouncing around at 90 or 95 cents, close it, right? 5, 10, 15 cents is definitely worth it. I know it's painful, but that's what risk management is. And we'll get back in the next trade, and you can see that based on our overall drawdowns and P&Ls, I think we're the most we've been down, and our real account has been in that $75 to $200 range, and we're making about $750 usually a week. And so therefore, we have one down week, will definitely be profitable for the month. So again, try to think long term. So what I want to do now is, this is totally hypothetical, but I definitely want to show you guys what I'm talking about on how we go ahead and set a trade up from an execution perspective, very mechanical, and then how to set the good to cancel order. So now we're going to go to simulation account right here. This is Amazon. You can see I am in the overall expiration for next week. Let's just assume that everything we've seen, that thing is going to be bearish. I'm not going to do any analytics on this. We see, for an example, that the expected market maker moves about 50 points, so we want to be above that. So above 50 points, so we want to be about 70. So let's say about 1670. All right. So again, we're just going to go ahead and We're going to right click it. We're going to sell. We're going to sell the vertical. We'll go ahead and sell 10, and we're going to make this a 5 wide strike. So we're going to change this and making sure that we're at 16.75. And you can see here that we're at 80 cents. So in order to get sure that we're filled, I'm going to move it down a few cents here just to make sure we get filled on our piece for our demonstration purposes. We'll hit confirm and send, and we send it. And let's see. Right, okay, there it is. Boom, we got filled. We're ready to go. So right away when you get filled, it'll say, okay, basically what's half of 75. So we want to go ahead and move that down and set a good to cancel order for that piece. Okay, we actually got filled at 80 cents. Okay, that's not real life. Okay, that's what happens with paper trading. They're always a little bit easier on your closing fills. So 50% of that would be 40 cents. So we'll go ahead and right click this. We'll create the closing order. We're going to close both legs at the same time. We see here that it says 80. So what we're going to do is you can either move it down or it's just easy. In this case, it's so far away to type it in. 40 cents, we still want it to be a limit order. We do not want it to be a market order. And right here, see, this is the day. This tells you that if I went ahead and hit confirm and send, that the end of the trading day, that this order would expire. I would no longer be on the books. But if we go ahead and set a good to cancel order, i.e. GTC, now we don't have to worry about it over the next couple days. If the stock continues to drop as we're thinking about in this hypothetical situation, it'll go ahead and hit our target, usually about half the time to expiration, so we're 7 days. So hopefully in that Tuesday, Wednesday time it would hit it. If not, we probably would get out. And so we just hit confirm and send. Oh, now the order is sent. We can go back to our monitor and we can see right here in our working orders that we have a 40-cent limit for a debit. It's a debit because we're buying it back. And you can see right here, time in force, that's what this stands for. Good to cancel, and we're good to go. Okay, so we'll paper trade a couple more of these over the next week or two, and then make sure that everyone is grounded. But now that we have kind of a good explanation, then we'll get to some real-time money opportunities. Again, we'll start off small. We may go down to 5 contracts just to start off, and then we'll get to 10, and we'll bring everyone along such that we're all comfortable with the risk and the mechanics in order to execute these trades and basically add some more profit to our portfolio. So that's all I have for you. Thanks, guys, for your time. Thanks for your patience. Have an awesome weekend, and we'll catch you on the flip side. Thank you.